Welcome back to EDS, and in this video I'm going to show you the reality of what it looks like to sell options contracts and manage them as well, because once you've put the position on and got them filled, you have 30 60 days to potentially be in this position, and I'm going to show you what it looks like once you have got positions filled. So this is a live portfolio. This is a very, very small portfolio. We've got 6 positions on at the moment. We closed one out earlier in the week as a winner. We took 50% of max profit. And now we've just got a couple positions left. 6 positions left that we put on in the last option cycle. The market did take a dip after the recent FOMC meeting that I will show you here. This little dip here, and this is representative, or that represents why we're in a bit of red here for some of these positions, but we're going to go into a bit of a deeper dive on each position. So let's have a look at the beginning, at the top, sorry. So GLD, we've been in this position for 17 days, 26 days left on the contract. We're at 36% of the way to max profit. If we just have a look at GLD, our short strikes are marked on the graph, and price is pretty much smack bang in the middle of the strikes, and there's really nothing to do on this position. This is a defined risk position. It is an iron condor, as we can see here. And there's nothing to do except just let theta decay, and everything's working out in our favor. So we just need to keep letting it do more of what it's doing. Next up, we've got Tesla, which is almost at break even, slightly in profit at 2%. We've been in this position for 13 days, 26 days left on the contract. Again, this is an iron condor position, and these are our strikes. So we got in around here, price came up, and then due to the recent market drop, price has kind of come back into the middle of the range. So our deltas, the market drop was a good thing for our deltas. However, it increased volatility. So both things kind of negated each other. Hopefully, we can just see a bit of volatility come out of the market, and if price can just move a little bit downwards or sideways, or even a little bit upwards, it's fine as long as we get the volatility come out of the market. So again, nothing to do for Tesla except just sit tight and wait. Palantir, we're at a break even on Palantir. And we've been in this position for 10 days, 26 days left on the contract. Again, this is an iron condor position. If we have a look at Palantir, Palantir just seems to be in this little range, and we're trying to capitalize on this range. IV is nice and high, so hopefully we can see a drop in IV. Again, short strikes are marked out. We are still within our short strikes. Absolutely nothing to do here, nothing to worry about. We just simply need to let more time pass on this position. We've got the Euro futures here. Again, this is an iron condor. We've been in this position for 17 days, 47 days left on the contract. And as we can see, our short strikes are marked out. Price came towards our short put, and then price seems to be moving back up towards the middle of our range, which is good for us. IV rank has been pretty much steady. And again, we just need to let theta decay, and we just need to let time play out on these positions. I'm sure by now you're picking up a common theme of patience. We just simply need to wait once we have put the positions on, especially if it's defined risk like these positions. Every position here is defined risk. They are all iron condors because this is a small account. Now we have got the Canadian dollar futures next. Our short put is slightly in the money here. Let's take a deeper look at this. Again, it's an iron condor. 47 days left on the contract, 23 days in. And as we can see here, the Canadian dollar has just come straight down. We put the position on around about here. Price has just been tanking. And then price has taken a little bit of a breather. We're back up to basically the same level of our short strike, which is at 0.7. Hopefully we can see price move slightly higher. Although the price right now is below our short put, we are still not actually loss making. If this was at expiration, we'd actually still make money here, because remember, the premium that we collect has to be deducted off of the short put price in order to get our actual break even level, which will be around here. So we're actually still in profit if price was to if this was at expiration, if price was to expire here on this contract. So nevertheless, we don't like cutting it this close, but this is a defined risk position, so there's nothing really to worry about. There is no unlimited loss potential here. We could roll the call side down a little bit, but then we would reduce our probabilities of success, and generally speaking, you only really want to do that for naked positions. Again, the price is virtually at our strike. There's not really anything to do here. It's just a case of simply waiting and seeing what happens in the market. And finally, we've got NVO with two contracts in the money here. Our both, obviously, of course, on our put side, the short call and the long call. We're 25 days in, 26 days left on the contract. This is an iron condor position. And as you can see here, everything was running very smoothly. And then we woke up one day and the market completely gapped down way below our short put. There's nothing that we could have done here. This does happen at times, and this is why defined risk positions are so powerful. If this was a naked position, that move definitely would have stung us a little bit. Because it's a defined risk position, our long, so this our short put is at 95 and our long is at 90. So everything between 90 and where the price currently is right now, 85, we've just basically saved ourselves $10 of pain times 100 contracts. Because each contract controls times 100 shares per contract, sorry, because each contract controls 100 shares. So that's $10 times 100. That's $1,000 of pain that we have saved ourselves by defining our risk upon entry. This is something that couldn't be predicted. This does happen from time to time in the markets. It was literally an overnight gap. And it just simply is what it is. There is still a chance that price could come up, and we could still make some money on this position. Don't forget, we have still got 26 days left on this contract, so almost a full month. A lot can happen in a month. If price can come down this aggressively, price can also go up as well. We don't need for it to go up that aggressively. Just anywhere around in and around this region here, and we'll be absolutely fine. We can roll down the call side. However, because this move was so violent and it was overnight, it moved too fast for us to be able to actually roll it down and still be able to collect a healthy premium for doing that. And every time you roll down and close this range and get the range tighter and tighter, you're reducing your probabilities of success. So for me, the trade-off wasn't worth it rolling it down in this situation because of the overnight gap. If price had, steadily gone down day by day, we would have had a chance to roll. However, because of the way it happened, it was an overnight gap down. There's really isn't anything to do, but that is why we had a defined risk position on in the first place, so that in the event of something like this happening, we're covered. Our max loss is set from the get-go, and it fits within our risk parameters. Now, how do you know how much money you should be allocating to your max risk, your buying power, etc.? Well, in order to know that, we've created a free position sizing template here that's free for everyone to use. The link is in the description. The way it works is you enter in the size of your portfolio. Let's say if you've got $5,000 in your portfolio, you can then enter in whatever the current VIX level is, and everything will then be automatically calculated for you. And at this point, you can simply use this information to form the backbone of your portfolio. It will tell you how much buying power, the maximum amount of buying power you should be allocating to any single defined risk, undefined risk position, how much of your portfolio you should be allocating to short premium strategies in general. And as long as you follow this over the long run, you'll be absolutely fine. If you want to learn in more detail about what we do and how we do it, link is in the description. This time, click on EDS Premium. Get yourself signed up. Inside, you will have access to our portfolios that will allow you to see in real time the positions that we're placing, how we're managing risk, how we're making adjustments, etc. There's also a full course inside as well, so no prior knowledge is required. We will teach you everything that you need to know from start to finish. If you get stuck, it is a private community, so you can speak with myself directly or with other like-minded individuals. There's a 100% money back guarantee. So once you have studied our full course and followed our trades for at least 6 months, If at that point you haven't been profitable, then we will work with you for free until you are, or you can simply request a full refund. So it's completely risk-free on your part. And right now it's £1 a month to join. The price is so cheap because we've just launched. The price will be increasing. However, once you're in, the price is locked in for you for life. So you are definitely rewarded for getting in early. And with that being said, I will see you guys on the inside.